Welcome to Talk Tickers, your essential shortcut to being well-informed on the latest earnings calls. Today, we're peeling back the layers on MidWestOne Financial Group's second quarter 2025 earnings call. We've got a truly fascinating deep dive for you a quarter that presented a real mixed bag. On one hand, some impressively strong underlying performance. On the other, well, a specific headline that definitely grabbed the market's attention and maybe overshadowed those positive signals. Our mission today is to distill the absolute must-know facts from this call, give you the full picture, and maybe spark some aha moments about what might be next for this dynamic regional bank. So let's jump straight into the numbers that made headlines. MidWestOne Financial Group reported GAAP diluted EPS of $0.48 and an adjusted EPS of $0.49. Now, this significantly missed the consensus estimate, which was $0.77. That's a noticeable gap, right? And it immediately raised eyebrows about the quarter's profitability. However, if you look at the revenue side, we saw a different story altogether. Total revenue, net of interest expense, actually came in at $60.23 million.
This beat expectations and showed a solid 4% increase year over year. So a real mixed bag right out of the gate, hinting that some robust core performance was indeed overshadowed by a particular singular issue.
It really was. What's truly fascinating here, if we connect it to the bigger picture, is how these numbers paint a classic illustration of competing forces at play. That substantial EPS miss wasn't a broad business decline. It was primarily attributed to a single significant credit event within the quarter. And that's a critical distinction for investors because it demonstrates how one isolated incident can skew overall reported profitability, even when the rest of the business, the underlying machinery of the bank, is actually performing quite strongly. It's about learning to distinguish between a one-off hit and sustained business health, especially in the regional banking sector.
That's a critical distinction, yeah, and it's exactly what we want to help you unpack today. The market certainly took note of that initial earnings per share miss, leading to a period of caution immediately following the announcement. But as you alluded to, the narrative shifted, and we've seen some recalibration since. So that's the headline everyone kind of fixated on. But now let's pivot to the details of that specific loan to understand why management is so confident it's a contained issue. We're talking about a $24 million Twin Cities commercial real estate, or CRE, office loan. This was the primary reason for the increased credit loss expense moving to what's called nonaccrual status during the quarter. This particular loan originated back in June 2022. Could you quickly clarify for our listeners what nonaccrual status means for a bank's financial books and why it immediately flags a major concern?
Absolutely. Yeah. Nonaccrual status is it's basically the bank saying, we don't think we're going to get paid as scheduled on this loan, either interest or principal. So it immediately impacts their profitability because they stop recognizing interest income. And crucially, they have to set aside reserves against potential losses. That's why this $124 million loan had such a disproportionate impact on the reported earnings number. Now, management on their side, they moved swiftly. They quickly put a receiver in place that's an independent third party appointed to manage and recover value from that troubled asset. They commenced resolution actions, established a specific reserve for this loan, and they were very clear in framing this as an isolated incident. They even did a third party review of all their CRE office loans over $1 million, finding 100% risk rating concurrence outside of this one problem loan.
Okay, so they were proactive, which is definitely reassuring. And what's crucial for you to understand, listeners, is that outside of this one problematic loan, other asset quality metrics generally improved. The credit asset ratio, for example, decreased by 32 basis points, and net charge-offs were only 2 basis points. So the picture wasn't universally grim for the overall credit portfolio. In fact, it actually looked quite healthy otherwise, wouldn't you say?
Exactly right. Management is guiding that provision expense, that's the money bank set aside for potential loan losses, should normalize in the second half of the year as this specific credit gets resolved. They anticipate allowance for credit losses, or ACL, coverage trending back toward approximately 120%. They've also indicated a charge-off related to this loan is likely coming in Q3. This kind of transparency and decisive action, it's absolutely key for investor confidence. Shows they're dealing with it head on.
That's a good sign, definitely. Now, here's where it gets really interesting for the underlying health of the bank. Beyond that single credit event, net interest income, or NII, increased $2.5 million to $50 million. That's a strong 5% jump quarter over quarter. Even more impressively, the tax-equivalent net interest margin, or NIM, and core NIM, both expanded by 13 basis points, reaching 3.57% and 3.49% respectively. Now, that's a lot of financial granularity. For our listeners who track these metrics but aren't knee-deep in them daily, what's the most important signal here regarding the bank's core health?
That's a great question because this NIM expansion is it's a key highlight. It signals true operational strength. Think of net interest margin as the bank's profit engine on loans and deposits. It's the difference between what they earn on assets like loans and what they pay out on liabilities like deposits. Simple as that, really. This expansion was driven primarily by higher earning asset volumes and yields, alongside lower funding costs. The core loan portfolio yield was 5.70%. That's an increase of 10 basis points from the prior quarter. And new loan originations averaged an even higher 6.76%. Pretty strong. And on the liability side, the cost of interest-bearing deposits actually decreased by 2 basis points to 2.29%. This shows highly disciplined balance sheet management, effectively playing financial chess, you could say, optimizing for both asset returns and funding costs. It's a tangible competitive edge, especially in a volatile rate environment like this.
Okay, so if I'm hearing you right, they hit one, maybe significant speed bump with that CRE loan, but their engine for generating profit from core banking activities is still purring. They're even finding high-yield opportunities on the lending side while also managing funding costs down. That's impressive. And beyond those headline numbers, the company reported solid growth in several key areas. Wealth management revenues were up 5% both linked quarter and year over year. SBA originations and gain on sale exceeded expectations, with year-to-date SBA gain on sale income doubling compared to 2024. That actually places them in the top 10% nationally for SBA 7A production. They also saw commercial loan production reach $215 million, which is the highest in the last 6 quarters, and residential loan production was up a robust 20% year over year. These are not small wins, are they?
Not at all. This strength in fee income businesses like wealth management and government guaranteed loans like SBA is a clear testament to their strategic plan roadmap. They're executing. And they're not just sitting back and watching the numbers. The second quarter saw significant new commercial banker hires in the Twin Cities and Denver, new wealth management hires also in the Twin Cities, and a new region president in Denver. These are described by management as seasoned and established bankers who are hitting the ground running. These aren't just expenses, they are strategic investments for future growth, reflecting their relationship-focused approach.
Okay, these talent and tech investments clearly signal a long-term vision. What's the typical lead time for these kinds of strategic hires and technology rollouts to genuinely impact the bottom line? And what does it tell us about management's confidence in their growth trajectory?
That's a great question because it really highlights the long game they're playing. While these new hires are impactful immediately on the ground, building relationships and pipeline, the full effect on growth, especially in commercial and wealth segments, typically has a longer sales cycle. It takes time for new relationships to mature and translate into significant revenue. So the big impact might be more evident in 2026. This definitely tells us management is confident in their long-term growth trajectory and is willing to invest ahead of the curve, expecting future returns. They're not managing quarter to quarter here.
Right. And what does this all mean for efficiency? Total non-interest expense actually decreased by $2.5 million quarter over quarter, driven by a $1.1 million employee retention tax credit. However, given these talent investments, the annual expense guidance for FY25 has been revised slightly up to $148 million, with an expected effective tax rate, or ETR, of 23%. It signals that while they found some efficiencies, they are prioritizing strategic investments in people and technology for the future. Seems like a trade-off they're willing to make.
Absolutely. And the company is also making significant technology pushes. They are rolling out an internal service now, which they call OneConnect. That's a new workflow program, and also a new commercial digital banking platform. Both are slated for October. These initiatives aim to streamline operations, deepen client relationships, and just, modernize their approach to banking. It's all about improving the customer experience and operational efficiency for the long haul.
Okay, so what does all of this, the resilient core, the credit event, the strategic investments, mean for the rest of 2025 and beyond? Management remains optimistic, expecting mid-single-digit loan growth for the second half of the year. This is driven by that robust commercial loan production we mentioned, $215 million, highest in 6 quarters, and solid momentum in home equity lending too.
That continued optimism is, it's grounded in their ability to execute, and it's encouraging. But if we connect this to the bigger picture of capital, the company completed a significant action. They redeemed $65 million of 5.75% subordinated notes due in 2030. This was partly funded with a $50 million senior term note with a floating rate of SOFR plus 175 basis points. For those less familiar, SOFR is a common market benchmark rate, and plus 175 basis points means 1.75% above that benchmark. It's a standard way banks manage their borrowing costs. This move was really aimed at simplifying their funding structure and reducing interest expense going forward. Smart move, likely.
And their capital position looks solid too, right?
Yeah.
Their consolidated common equity tier 1 or CET1 ratio increased to 11.02%. That's just above their target range of 11-12%. Management also indicated they were active in the market with stock purchases in June, supporting the stock when they believe it's below intrinsic value. Which raises an important question. What about mergers and acquisitions? The CEO stated the company is becoming M&A ready. What does that mean in practical terms for their strategy, and why should our listeners care?
This M&A ready talk is it's a significant strategic signal. Our listeners should definitely care because M&A can be a major catalyst for regional banks. The CEO, Chip Ree, wasn't just hinting, he was practically broadcasting their readiness for strategic growth. He emphasized that their underlying earnings momentum is getting much, much better and their infrastructure is ready.
Yeah.
They're looking for targets with assets between $500 million and maybe $1.52 billion. And they're prioritizing geographic density within their existing footprint. Think along the I-35 corridor from Twin Cities down to Kansas City and I-80 through Iowa out to Denver, or maybe accretive business lines with a strong cultural fit. This isn't just about getting bigger, it's about gaining scale, improving efficiency, and diversifying their revenue streams in what's still a pretty competitive market. It's a clear message. They're on the hunt.
Okay, so they're clearly playing the long game with these investments and now potentially acquisitions. The initial market reaction was certainly one of caution, though. The stock saw a noticeable dip on the day of the earnings call, and trading volume was significantly elevated. That makes perfect sense, given the EPS miss.
It does. However, what's truly interesting is how the overall sentiment quickly shifted to what we're calling cautious constructive. Despite that initial EPS miss and the CRE headline, the stock has shown a strong rebound in the month following the call. It's actually outpaced both the broader regional bank ETF, KRE, and even the S&P 500. Analysts generally maintain a moderate buy consensus, with price targets ranging from about $30 to $34.50. This suggests the market is recalibrating, looking past that single credit event to the company's underlying earnings momentum and strategic investments, recognizing the contained nature of the issue.
And looking at the broader industry backdrop, the Federal Reserve held its target rate range at 4.25–4.50% at the end of July. Officials signaled possible rate cuts into September, primarily in Q4. What could that mean for a bank like MidWestOne? A potential tailwind.
Yeah, those potential rate cuts could definitely serve as a tailwind. It could help lower deposit costs further and potentially expand NIM for banks like MidWestOne. However, it's also important to remember that commercial real estate office loans remain a watch item across all regional banks. It's a sector-wide concern. That really underscores why MidWestOne's specific event garnered such attention in the first place. So while there's a potential tailwind from rates, there are still these sector-wide headwinds to monitor carefully.
Okay, all right, listeners. Now for the segment where we put on our most speculative hats. We're going to pitch some outrageous but plausible trade ideas, just like a hedge fund analyst making a case to the investment committee. Remember, this is purely for entertainment and conceptual exploration, and this is absolutely not financial advice. Always do your own research. Got it. Good.
Okay, given the unique dynamics of MidWestOne's quarter, where that single contained credit event overshadowed strong core performance, I'm proposing a kind of nuanced play. My first thought is a short-term relative value trade. Go long MOFG with a corresponding short in a regional bank ETF like KRE. The thinking is the market has already punished MOFG for what management insists, and the data seems to support, is an isolated issue. Yet their core NIM expansion and NII growth are actually outperforming the sector average. So we're betting on MOFG continuing its recent alpha capture against the broader regional bank sector as the market fully digests the isolated issue narrative and that Q3 provision normalization comes into view. We're looking for maybe that quick 5 to 7% outperformance in the next few months, a tactical play.
Intriguing. Okay, so essentially you're suggesting the market overcorrected for something they see as a one-off and the underlying strength will continue to shine through relative to its peers. What if we stretch our time horizon a bit for a more aggressive, maybe longer-term play?
Exactly. For that slightly longer-term, more speculative play, let's look at converting the M&A ready talk into action. Like we said, CEO Chip Ree is practically broadcasting their readiness for strategic growth, and their specific search criteria. So, my pitch, a long-dated call option strategy on MOFG, let's say 12 to 18-month expiry. Pair that with maybe a small, strategic long position in a basket of regional banks that fit their stated geographic inches, that I-35 and I-80 corridor, sub-$2 billion assets, strong culture. The idea is if MidWestOne executes on their better is better philosophy and secures a high-quality, digestible acquisition, the market could significantly re-rate the stock, recognizing the increased scale and efficiency. The call options give us leveraged exposure to that potential M&A pop, while the basket, well, it serves as a kind of reconnaissance mission for potential future targets that might become attractive in the M&A landscape anyway. It's definitely an aggressive bet on management's strategic vision translating into tangible value accretive expansion, but the setup is certainly there for those willing to take a calculated risk on M&A actually happening.
What a setup. Okay, so in summary, MidWestOne Financial Group's second quarter was indeed a tale of two narratives. You had strong underlying operational performance and robust growth engines, unfortunately overshadowed by that single significant nonaccrual CRE loan. Management is clearly confident in their strategic direction, their robust loan growth projections, and the expected normalization of credit costs in the second half of the year. The market's initial cautious reaction has since recalibrated, reflecting a, let's call it, cautious yet constructive outlook as the company executes on its long-term strategy. That strategy includes optimizing funding, growing core businesses, modernizing its platform, and positioning itself for potential M&A. Thank you for joining us for this deep dive into MidWestOne Financial Group's latest earnings. Before you go, maybe consider this. In a world dominated by banking giants, does MidWestOne's story, a nimble regional player weathering a specific storm while aggressively pursuing growth and M&A, offer a blueprint for future resilience for others? Or is it just a unique case study in navigating a challenging landscape? Keep an eye on how these smaller players leverage their agility against the Goliath. It's often quite revealing. Remember, nothing discussed here is financial advice, and we always encourage you to do your own research. We look forward to your thoughts and feedback.